Hey guys, Jared Wesley here of Live Traders, and it is that time of the week. It is lecture time. This week's topic, guys, is on the 7 stock market events, right? There are 7 things that the stock market can do. Many of you are very familiar with, oh, it can go up, it can go down, it can go sideways, right? Uptrend, downtrend, sideways trend. But many of you aren't familiar with how the market or how stocks transition from those uptrends into downtrends and downtrends back into uptrends. And because of that, you're finding yourselves on the wrong side of the market too frequently. In fact, you could look at probably 70 to 75% of trader losses are people that are on the wrong side of the market. So it would be very helpful to learn when not to be on the wrong side of the market, when not to marry your bias. So today I'm going to talk about those 7 stock market events, give you a lot of different examples of them, so that you won't ever be on the wrong side of the market ever again. And like I said, a lot of people have a FOMO, or they have the need to be right, this fear and greed, etc. So we're going to have to check our egos when you go through this this lecture today, guys, because a lot of the times it's the ego that's keeping you into a trade or pushing you into a trade that you should otherwise have not taken, or not getting out of a trade that you're already in that you shouldn't have taken. Okay, so today's lecture, again, will keep you on the right side of the market. It will help you determine when the market's going to pivot, when the market's going to turn, when you should get in, when you should get out, as well as checking your ego at the door, because marrying your bias is a very, very dangerous thing to do. As always, if you guys like this video, please click the like button and hammer, smash, crush that subscribe button. I'm Jared Wesley of Live Traders. Let's get to it. This week's topic, guys, is the 7 stock market events. And we've talked about some of these individually here or there, but we haven't really put them all together in one lecture. So I thought it would be a good time to do that because a lot of what people do is predicated on what the market does, right? So when we say the market, a lot of these relate to individual stocks as well as the market. So I think it's an interesting lecture because after this lecture, for the most part, you should be on the right side of the market most of the time. We're not robots. We're not, we're people, so we make mistakes. You won't always be on the right side of the market. But after this lecture, you should largely be on the right side of the market. Having said that, we first must do, when will the insanity stop? When's it going to stop? This week's is, I don't want to say it's typical, but it's another in what I would consider sad story. And you know, the point in doing these every week, and hopefully they don't get old for you guys. Yes, we have a little bit of a laugh, but you know what, guys? That's at somebody else's expense. And I'm sure it's not funny to that person. I'm sure they know they've messed up. Some people take once to learn, twice to learn, 3 times to learn. But some of these stories are, they're pretty heart-wrenching, honestly. And this one here is no different. Blew up $300,000 in options trading, okay? So I've lost about $300K US dollars in options in the last 3 months, okay? I was feeling like killing myself. This is not a good thing so much, but I have finally recovered from the really negative thoughts. Look at this. I have $10,000 in savings now, and I guess I will start again from ground zero. I don't think I need to go much further than other than say you really shouldn't be putting yourself in this position. Okay, this unfortunately, as you see every week, happens to somebody. It's happening to somebody right now as we're talking. Okay, it's going to happen to somebody tomorrow. I don't know how to stress this enough. I say it frequently, but I'll say it again. Trading is a serious, serious business. Yes, I get it. There's a lot of Google advertisements, Facebook ads telling you how you're going to get rich quick and dominate the universe in 3 months or 2 days or 1 week, and how I turned $500 into over $1 million and blah, blah, blah. Don't buy into that crap. This business is hard. One of the hardest things, if not the hardest thing that you'll ever do. So I do these when the insanity stops as wake-up calls every week, because I don't think doing them once or twice a year is enough. And I don't even know if every week is enough, but hopefully each week when you watch these, you go, you know what? I'm going to start listening to this guy and start taking this seriously. As in, money management is your #1 job. Doesn't matter how badly you mess up a pattern. If you're only risking $5 or $10, you're never going to get hammered that badly. Okay? So anyway, pretty bad stuff, guys. 300K in 3 months. All right? Let's dig in. The 7 stock market events, market possibilities. These are basically the only 7 things that the market or an individual stock can do. Okay? And this is the slide that I was saying a minute ago that I find just interesting, the timing of it. Okay? And this is not something new. This is in, I don't know if this is in PTS or not, but we certainly have talked about this before. Most stocks move with the market, right? You see that comment, a rising tide lifts all boats. Well, I would say 70+% of stocks move with the market, okay? Most traders lose because they're on the wrong side of the market, right? If you lose on a trade, not always the case, but largely, most likely the case you lost on that trade is because you were on the wrong side of the market. Okay, and this is one of the areas for those of you who have taken professional trading strategies where we do talk about relative strength, right? Relative weakness, relative strength is important because it gives us more flexibility where we don't have to be on the right side of the market, or at least we can be wrong by a little bit and still get away with it, right? You guys remember that? So you can still be wrong by a little bit and still get away with it. If you're going to take stocks that have a high correlation to the market, you better be very certain, very confident about your market direction for that day. And today is a good example. This morning I said, guys, I think the markets are going to go lower today, right? I think they're going to pull back. We've been up a couple days. The 60-minute, 15 minutes extended. I think we pull back today. Well, I was wrong. We pulled back early on, and then we've been higher ever since then. Whereas if you took a relative strength or relative weakness stock, it wouldn't mean as much. It may not be shooting the moon and you may not be having a great day, but you're not probably getting hammered either. So the point simply here is most stocks do move with the market. So try to be on the right side of the market. And that's what today's lecture is about, how to stay on the right side of the market. Okay, how can you do that? So these are the 7 events that we're going to talk a little bit about today. Okay, and I'll be honest, I believe, and I might be wrong on this is the only text slide in the whole presentation. So most of you will be happy you get your little trader porn today. It's all charts, okay? It's all charts. So some of you are going, oh, this is going to be boring. It's not. There's a lot of good stuff here. Uptrend, downtrend, sideways trend, breakout, breakdowns, uptrend break, and downtrend break. Okay, these are basically the only 7 things the market can do. Sure, within these 7 events, there are variations, right? A sideways trend could be a very choppy, sloppy, stage 3 type sideways trend, but it could also be a very narrow range, flatline, stage 1 type sideways trend. It could also be what? A pause that refreshes, which is like a stage 2 sideways trend. Or you're in a stage 2, you go sideways for a little bit before you continue to move higher. So there's variations of each one of these trends. So knowing these events will help ensure that you're never on the wrong side of the market. Now, never is a pretty strong word. That's never going to happen. There will be times when you're on the wrong side of the market. Sometimes it's because you read the market poorly, and sometimes it's because the market does something very unusual. But most of the time, you should be on the right side of the market by knowing these different events. Okay, everybody I think is pretty obviously clear with what an uptrend and a downtrend and a sideways trend are. It's these 4 on the bottom where I think people make mistakes. They don't know where the market turns or where a stock turns, and that's what gets them in trouble. Let me repeat that. Most of you get in trouble because you're not sure when and where the market's going to turn. Okay? When you're in a stock and it's too extended and it's going to pull back and you stay in it anyway. Or you get into a stock that's already too extended. How often do we see that in the chat room? Right? How often do we see somebody that's asking about a stock on a 5-minute chart and it's up 8 bars in a row? Hey, Jared, check out CTAB or whatever the stock might be. Well, it's already up $4 today and it's a $3 stock. And it's up 9 bars in a row. Well, it's probably closer to a pullback than it is to going $4 higher. Now, will there be exceptions to this? Of course. I can't remember the stock. Was it FSLR? I don't remember what it was, but it was up like 18 days in a row a while back, a few months back. Those things happen, but we're not after the unicorn or the needle in the haystack. We're after, is it JKS? We're after what happens most of the time. I want that to be clear. We're after what happens most of the time. There's always going to be outliers on both directions. Okay, but that's not what we're after because we don't know they're outliers until they're outliers. Does that make sense? So you can't predict an outlier. So we want to know what happens most of the time. Okay, so let's dig in a little bit. And this is interesting. I'm going to show you this chart twice. Okay, this is the Dow Jones Industrial Average from 1897 till this year. And you can see 30,046 was that high. I think it was the all-time high. I might be wrong on that, but it's close. Okay, so this isn't too long ago. This is a week ago, a few days back. That's 123 years of information. And what I want you to take a look at this chart, and don't worry, we're going to see it again, but with arrows on it in just a second. Isn't it interesting, guys, whether you're in the 1800s or the 1910s or the 1930s or the 1970s or right now, human nature does not change, right? We might think we're more evolved or more advanced than we were 1,000 years ago, but we still have the same emotions that we've always had. We're human beings, okay? Fear, greed, the need to be right, ego, all of those things. And you can see this over the last 123 years represented in the Dow Jones Industrial Average. Okay, so this will answer a couple questions. One, it'll answer the question of, Jared, do you think technical analysis will stop working? No, I don't. Okay, unless human beings get chips put in their head and they no longer have emotions, until that day happens, okay, charts are always going to work because they're based upon humans. And we all have fear, greed, ego, and, right, we don't want to lose. And we want to win. So we can see that over the last 123 years. Human beings pretty much stay the same, okay? And within this, and this is where I wanted to jump to, what do we see here? I put arrows on these things, and I'm doing this as a learning lesson to you guys. On the next chart, I'm going to show you what each one of these arrows represents, but I want you to just take a quick look at it. Maybe you'll rewind this later, whatever, and just take a look what these arrows represent, okay? So take a look at the arrows, because I want you to look at them before I give you the answers to them. I'm not going to ask you what the answers, but I want you to take a look at them before you get the answers so you can kind of get your brain thinking. And this is what it looks like. Now, they didn't even have technical analysis in 1909, 1929, okay? But yet, it was valid back then, okay? So you take a look here. We'll start over here. Early 1900s. What do we have? A breakout, right? Consolidation. We even have an engulfing bar, narrow range consolidation breakout. Chops around, breaks out again. Breaks out to the point where it gets climactic, and you get a little bit of a mini climactic sell setup. And this was the 1920s, right? 1929, etc. Then you had the stock market crash, which gives you what? Climactic buy setup. And right after the climactic buy setup, you get a 3-bar play. And that 3-bar play, and then this is a yearly chart, several years later is followed by a buy setup, which is followed by a mini breakout, which is then a huge bullish run from the 1940s after World War II all the way up to what? About 1968, 1970, give or take. And then the markets went through what I would consider to be the longest flat period they've ever had. This is like a 15-year period, maybe a little less than that, but give or take a 15-year period where the markets were just dead sideways. And for a while, people weren't sure. Are we ever going to break Dow 1,000? Seriously, if you go back and look at articles from the 1970s, people were worried, are we ever going to break Dow 1,000? Well, guys, 1981, 82, we broke out. The Dow was at roughly 1,000 to 1,100 at that point. Where are we at now? 30,000. 30,000. Okay? So a 30-fold increase. Now, I'm gonna veer off on just a tiny little 2-minute tangent, so bear with me. You know when I talk about wealth building, and I tell you guys that there's absolutely, unequivocally no excuse whatsoever for every single American to not retire with at least several $100,000, if not millions. This chart should prove how easy it actually is, right? If you put away $50 a month from the time you graduate college till the time retirement happens at 62 to 65 years old, $50 a month. 95% of Americans can do that, right? And if you can't, then go get a busboy job on Friday night. Go get an Uber job so you can make $50. Put it in a total market fund, VTSAX, VTSMX, VTI, Vanguard, whatever product you want, a total market fund, and you do that for 30 or 40 years, and you'll have $250,000 to $300,000, and that's $50. Most people can put away more than $50 a month. 100, 200, we'll do the math. Put away $100, now you have $500,000. Put away $200, now you have $1 million. $200 a month, now you have $1 million. There's absolutely unequivocally no reason that just about every American, 90% of you, can't retire with a 7-figure retirement. You know what the problem is? You're undisciplined and you're not taught properly. Our schools in this country don't teach you anything about personal finance. This is not a political statement, it's a factual statement, okay? You don't learn personal finance. All you got to do is take a total market fund, take 10% of your income, whatever, 20% if you can, and put it away. Wake up at 60, you're retired, you're done. You control it. So, back to this chart. That was my 2-minute tangent there, okay? Breakout. We have a huge run, perhaps the largest bullish run in history, at least in the last 120 years. Chop around, we pull back. Okay, we have the financial crisis. We bounce back up, we pull back again, and then we rip. Now note, that bottoming tail is the Rona tail, the vid tail, okay? The market's pulled back significantly. Now just think, that's sitting somewhere around 18 to 19,000. You're already up over 50% from the bottom, and that was in March of this year. That's 8 months ago. You could have made a 50% return from the bottom, okay? So the point I'm simply making here is these stock market events, these patterns that we teach, buy setups, double bottoms, breakouts, breakdowns, climactics, okay, 3-bar plays, they absolutely happen in the overall market, not just in stocks in general. If you can chart it, these patterns happen in it. You could chart the sale of pet rocks, okay? These happen in it, okay? So be aware of that. Now, the question is, of the 7 stock market events, which one speaks to you the most? The reason I'm commenting on this is when you're a newer trader, you should be focused on maybe 2 patterns, 1 to 2 patterns. I have a lot of people come in and they want to focus on everything. You're not ready for that yet. Pick your 1 or 2 favorite patterns and focus on it, okay? Some people prefer breakouts, some people prefer pullbacks, etc. But one of the things I wanted to talk about today, guys, is how things happen, okay? So right here, if you take a look at this chart, we're clearly in an uptrend, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. You can see the moving average going higher. This is clearly an uptrend, okay? But where some people mess up is what they consider a breakout, or how something breaks out, or how something breaks down, okay? So when I put a line here and question mark tradable, well, guess what? Technically speaking, this is a breakout because this is a double top and it's what I call a narrow range consolidation. Maybe not, but you're breaking above multiple prior pivots highs. So by definition, it's, quote, a breakout. But there are tradable breakouts and then there are breakouts. Okay, so the question is that tradable? Maybe. Depends what your expectation is and on what time frame in which you want to trade it. But would I tell somebody in the morning at 9:35 or 9:34, oh my gosh, buy this over the high because it's breaking out? No, because there's no pattern here, unless you're looking at a higher time frame and you're going to use a stop loss way down here. Do you see the difference? So the expectation here is different. If you're just going to get in here on a 1-minute high, 2-minute high, 5-minute high, and you're going to put your stop loss at the low of the day, that's not a proper breakout. But if you're going to put your stop loss under yesterday's low or even a little more than that, then I could say, yeah, that's a proper breakout. But that might be a 2 or 3 day hold. So expectation matters. We're going to talk more about this in a minute. So we have a move higher, a pullback to support, rising moving average, buy setup goes higher. That's pretty easy stuff. Okay, like I said, uptrends, downtrends, sideways trends are usually pretty easy for people. It's the 4 on the bottom, the trend line breaks, the breakouts and breakdowns that most people muck up. Okay, so again, breakdown, right? Sideways consolidation, breaks below the pink line. Shortable seems to be, right? It's a pretty lengthy breakdown. Topping tails, get a little extra confirmation. You probably have to put your stop loss up here, goes lower, bounces, little sell setup. Now, Does anybody notice anything about this chart? I put this specific chart in here on purpose. Does anybody notice anything about this chart before I continue? Again, I put it in here on purpose because I'm tired of answering this question. I get this question very, very frequently. Now, it's a little hard to know exactly what it is, but I'm seeing if anybody notices anything. I'll give you a hint. Look at the hours on the bottom. It will help determine what type of chart this is. Ooh, there it is. Somebody got it. Ding, 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 Greg. This is a Forex chart. This is a Forex chart, okay? I get the question almost on a daily basis. Can these patterns be applied to Forex? Jared, does the 3-bar play work with Forex? Do sell setups work with Forex? I get this question almost every day. Yes, if you can chart it, you can trade it. And if humans are involved in it, you can almost definitely chart it. Okay, so this is a Forex chart. Okay, it's a currency pair, right? Breakdown right here, pulls back pretty significantly, bounces back up, sell setup goes lower. Pretty crappy sell setup down here, but just note, you're following the trend line down. You have a breakdown here and you have a sell setup here. Okay, so the point of this chart was simply to say, look, yes, you can chart Bitcoin, you can chart Forex, you can chart just about anything, all right? And when you get those patterns, they're going to be valid. Now, obviously, we didn't talk about volume in here, but the truth is in Forex, volume is less of a concern than it is in stocks because it's so much more liquid. You could absolutely chart the sale of pet rocks, and I'm sure someone has already done it, Alex, because you can chart the sale of anything, all right? And guess what companies do all the time? Chart their sales, okay? They want to know what times of the year they're most effective or least effective, et cetera, and so forth. All right, so here's another breakout. There's a breakout down here, moves higher, gets far from the moving average, consolidates back towards the moving average, and breaks out again. So this is the easy stuff for most people because these are the obvious ones. The next couple charts are the ones that are a little less obvious and the ones that most of you are messing up. So a standard buy setup, easy. Standard breakout when it consolidates for, I don't know, 20, 30, 40, 50 minutes. I think this is a 5-minute chart. No, maybe it's not a 5-minute chart. Okay? So this is easy stuff. What's next, like I said, are the breakouts and breakdowns and trendline breaks. These are the ones that are most misunderstood. And here's the rub. You have a stock that's in a sideways consolidation. Moves up, pulls back, moves up, pulls back, moves up. And too many of you guys and girls out there think as soon as it breaks this blue line right here, right there, it magically becomes a breakout. Well, technically it's a breakout because it's breaking the prior pivot high, but it doesn't mean it's a breakout in the traditional sense of a breakout, that it's a buyable breakout. Do you see the difference? Yes, it's a breakout, but is it a buyable breakout? And I think I see a lot of traders mess this up. And this is where, for example, when we first started this lecture, I said we see a lot of people, especially in the chat room, they're buying stocks that are up 5, 6, 7, 8, 9 bars. Well, you guys are buying stocks. Let's just say it bounces off the bottom here and it goes up 1 bar, 2 bars, 3 bars, 4 bars, 5 bars, 6 bars, breaks out 7 bars. And you guys are like, hey, Jared, can we buy this? It's a breakout. No, you can't buy it because it's up 7 bars. I get that it just broke the prior pivot highs and technically it's breaking out, but how it got there matters, right? So where it came from as well as how it got there both matter. So this came from a double bottom, which is fine, but how it got there is not fine. Got there after 7 bars up. And this is where so many of you are getting caught, what I would say or call, on the wrong side of a stock or on the wrong side of the market. Because you're like, but when I took it, Jared, it was bullish. It really wasn't as bullish as you thought it was because it was already up 7 bars. Okay? And this is also, and I'm not going to get into this as much today, where pre-market charts matter, right? And not to rehash an old thing, but Tesla's pre-market chart today mattered. That page in PTS, guys, when we talk about pre-market charts and you see that huge waterfall before the stock bounces, guess what that huge waterfall, for those who have taken PTS, guess what that huge waterfall was? All pre-market data. And if you didn't have the pre-market data, you probably would not have felt comfortable buying it at 9:35 on, quote, a 5-minute high. But it actually wasn't a 5-minute high. It was actually a climactic buy setup because you had the pre-market data. So today, Tesla was not nearly as aggressive as somebody made it out to be because the pre-market, I wouldn't call it a waterfall, but because of the pre-market chart selling off and then the intraday chart selling off with a huge wide range bar and a bottoming tail. Okay? And then a double bottom, and then on a 1 minute, a triple bottom, and by that point, it was over. It was over. And as you guys know, Cliff rarely makes mistakes. It was in that thing at 548 long. Okay? Anyway, back to the original point. You're up 7 bars. Don't buy that breakout. If you're up 7 bars, meaning how it got there is extended, you have to wait for the pullback. Guys, what's the safest spot on a chart to buy a stock? Does anybody know? What is the safest area on any chart to buy a stock? Somebody just said the bottom. How do you know it's the bottom? Right? The safest area to buy any stock on a chart is the first pullback after a breakout. The first pullback after a breakout. Okay? Because when you buy this double bottom, sure, it may do exactly what this stock did. But you're not in an uptrend yet. So you're actually buying a stock that's not actually in an uptrend and you're going long on it. Right here, you're buying a stock that you know is strong. We know it's strong because it broke this prior pivot high or multiple pivot highs. So there's no more resistance. And remember, the ceiling over here, right here, the ceiling, becomes the floor over here. So now that we've broken above that area, we know the stock's probably a little tired. But we know it's also strong because it broke above this area. So what's the stock going to need? A resting period. So you have 2 types of rest. Correction through price or a correction through time. A time correction is a consolidation. A price correction is a pullback. So this right here is one of the single safest areas that you could ever buy a stock. Okay? Preferably on a 40 to 50% retracement. This one might be less than that. But you have a stock that broke resistance, now is pulling back to support. The resistance becomes a support and now bounces back up. You know it has commitment because it broke above the resistance. So if you can find a way to buy a stock in this area, they very rarely fail, okay? Unless the stock is already crazy extended, all right? But if it's pulling back to this area of support, it's probably not that extended. Same on the short side. The safest area to short a stock is after it's broken below support and bounced back up into what would now be resistance, right? The support becomes the resistance over here. Okay, so these are 2 of the safest areas that you can buy. Just remember, don't randomly buy the breakout. You have to understand how it got to where it is. I'm seeing this mistake over and over and over and over again. We saw it today, for example, on what was that $8 stock? Was it BB? I said, don't just buy it at $8, guys. Don't just buy it at $8. Popped up just over $8, shook everybody out, and then it went higher later. Because how it got there matters. Okay, how it got there matters. So, here's an example. This is a stock in a downtrend, gets a little bit climactic. You can see the bottoming tail. You see the massive, crazy volume. Goes a little bit lower, bounces, retest, consolidates. Now, here's the thing. Would you just buy this thing right here at like $9.30, whatever it is, right there? No. How it got there was after a somewhat extended move, okay? So you look at this and you're going, wow, breaks out of this consolidation, takes out this, takes out, all those things are great. Like that's what we want to see, right? Taking out this pivot, this pivot, this pivot, this pivot, like 4 pivots. But I'm not just going to buy the top of this bar because it broke out over here. Because the consolidation wasn't at the top of the range. The consolidation was near the bottom of the range. So some of you would be tempted to simply buy this wide range green bar, right where that red line, right where this blue arrow and red line intersect. Some of you are just going to buy that. That's not a good spot to buy the stock for 2 reasons. 1, it's tired when it got there. And 2, your stop loss has to be all the way down here, which is a wide stop loss and it's on a tired stock. So in this case, it's better to buy the 4-bar play. But here's the rub. We don't know if this 4-bar play is actually going to happen. And this is where newer traders really find themselves in a conundrum. They're going, but I know it's breaking out. I need to get in this thing. And then every once in a while, guys, a stock will break out and it'll go straight to 13 bucks with no stopping, just straight up. And you're sitting there going, I knew I should have bought that stock at 9.25. I knew it. But it didn't have a pattern. And if it did, you had to put your stop loss down here at like 8.25. In this case, you get lucky, fortunate, whatever you want to call it, and it gives you a 4-bar play. So this is a no-brainer. You buy it at 9.50, put your stop loss at like 9.20 or whatever that area is, and now you're off to the races. That's awesome. But new traders will buy it right here where the blue line is, the blue arrow is, because they're so worried it's going to go straight to $13. It's called FOMO, right? Fear of missing out. And guess what? Sometimes it will. And guess what? Oh well. Just oh well. There's going to be another stock out there, another pattern out there. For example, today, what was that stock today? Was it CATB? I can't remember what it was. You had one opportunity to trade that stock today. And if you missed that opportunity, in my opinion, there really weren't any other opportunities. Oh well. It's not the end of the world, guys. I mean, I know we all have this opinion like we're going to buy into it and sell it at the 2 pennies from the high of the day, but realistically, you weren't going to do that. You're going to get your 2R and move on. So what difference does it make? It's just 2R. Does that make sense, guys? Meaning, sure, there are some of you that are shooting for huge targets. I get that. But for the vast majority of traders, it's just another trade. Just because it went 27R doesn't mean you were going to get 27R out of it. But that's the way you act when it goes from $9 all the way to 15 without an entry. And you jump on anyway, and then it pulls back and bites you. And occasionally you'll get lucky. So please understand where something comes from on the breakout really matters. And also understand that you may not get that secondary entry. You might. Most of the time you will. Right here you have a 4-bar play and a breakout over here. So you have 2 opportunities. 1 to get in here and 2 to add over here at 10, 20 or whatever that area is. And then shoot for that target back up here. Most of the time they'll do that. But every once in a while you get those JKS stocks and they just go straight up for 15 days and there's nothing you can do about it. Get over it. It's just 1 out of 4,000 stocks. Find another one. You will. I promise you will. All right. This is another example. Here's a stock on a lower time frame. The last one was on a daily. This is a lower time frame. We're chopping around. Guess what? We gap up to 85.50, give or take. We get ripped right to 86. Some of you are going, yep, I'm just going to buy the 5-minute high. Can't do that. You're going, well, it's a breakout. But you're going to put your stop loss down here at 85. Well, if you're going to buy the breakout at 86 with no pattern whatsoever, your stop's got to be down here at 84.50 because that's the bottom of the consolidation. But we all know you guys cheat. We all know that you buy 5-minute highs with no pattern at 86 and then you just put your stop at the low of the day at 85 or 85.50 or wherever the heck you feel like it. And then you lower the odds. Or the risk to reward isn't that good. Or your expectation is not in alignment with what you're actually trying to accomplish. You're trying to get in at 86 because of FOMO on an intraday chart that you have no intention of holding overnight with the widest stop in the world. You're never going to hit your target on that. So yes, it broke over this pivot and almost over this topping tail. So what do you have to do? Wait. In this case, you got fortunate. It gave you a 5-minute 3-bar play at $86 with a stop at 85.50, 50-cent stop. It went $1.53 to 1. But what if it didn't stop on bar number 2 and it just kept on going? What if it finished bar number 1 right here at like 85.70 and just kept on going higher? Basically, what I'm trying to tell you is imagine, visualize for a moment, erase bar number 2. See the red bar? Erase it. What if bar number 1 happened and then this was bar number 2? You can't buy it at 86. Your stop loss has to be down here at 84.50 because you're not taking an actual 5-minute pattern. You're taking the breakout. And the bottom of the base on the breakout's 84.50. And I know what some of you are thinking, what's the big deal, Jared? If I'm right, I don't need that stop loss. Well, clearly over here, it would have mattered, right? If you bought it at 85.50, it would have stopped out. And over here, we would have stopped out again. So why couldn't that happen over here? It could. So either wait for the pattern or use the super wide stop. But if you're going to use the super wide stop, please understand, It's $1.50 stop loss, and you might need to hold this overnight to get $3 or $4 from it. Wait for the pattern. I know it's hard. Some of you are going, yeah, that makes a lot of sense, but tomorrow morning you're just going to take the trade anyway. Wait for the pattern. And in this case, you got one, a really good one. So yes, you do have a breakout right here, but you don't have a buyable breakout until the 3-bar play forms. That's the key that I want you guys to understand. You have a breakout, but you don't have a buyable breakout until the 3-bar play happens. Okay? All right. Couple examples in this one, guys. All right? So we have a stock that's in a downtrend, right? Lower low here, lower high. Not quite a lower low, but a lower high again. A lower low here, a higher high, lower low. A sloppy pullback on this thing. I mean, this thing really is sloppy. Big green bars, big red bars, but it's in a downtrend. You can see here the blue trend line. So this stock gaps up right here and moves above this prior pivot and this prior pivot. And it actually gets to the point in which you would probably consider trading it, right? Because you're taking out pivot 1, pivot 2, pivot 3, and almost pivot 4. Almost, not quite, right? And what do you get? You get a 3-bar play, right? You get a wide range bar followed by a narrow range bar, and it triggers. And it shakes you out, okay? So you have two choices here, okay? You can either use the 84% rule and get back in, but it looks like you probably would have been tagged twice, just barely. And that would have been super annoying as the stock goes higher. But a couple things we need to consider here, and this is how you should work through every single trade. The stock is in a downtrend. Yes, you could argue it has a little double or triple bottom down here, right? Bottoming tail, pivot, retest, bounce, retest, gap up. That's good. It's a good sign. But what's one of the things we talked about before we even got to the pattern? How sloppy this pullback was, right? How sloppy this downtrend was, because it is. Well, if this downtrend is so sloppy, what does that likely mean? The move back up is probably going to be sloppy. Well, it proved to be sloppy, okay? But we should have kind of suspected that, right? Because the move down was also sloppy. So anyway, gap up, wide range bar. Well, one of the things about this wide range bar is it's pretty big, hence wide range bar. So if you look at the average trading range of this stock, it looks like it's doing about $15 a day. 540 is the high here. 525 is the low, maybe a little less, $15, $18 here. 535, what's the low? 520, roughly $15. 525, what's the low? 515, $10. What am I getting at? The average trading range seems to be between 10 and 15, 10 and $20. Well, this first bar of the day isn't quite that. It's about $7 or $8. So it's about 50% of the trading range. Okay, that's pretty good actually. Considering it does $10 to $20, we should have at least $5 or $6 left in this thing with about a $3 stop loss. I'm assuming it's about $5.28, $5.27.50. All right. So point is you might take that 3-bar play and it would be a legitimate, honest 3-bar play. But understand that the sloppy pullback likely means a sloppy move back up. You guys, right out of PTS, clean pullback, clean move back up. Sloppy pullback, sloppy move back up. Okay. So we're not quite over that area. And unfortunately, that area was stronger than we may have thought, right? We took out this pivot, but we didn't take out that pivot. And that's where the stock got spanked. So there are a couple reasons not to take this sloppy pullback, plus the 3-bar play is not entirely over this pivot. Some people might argue, well, it's close enough. Sometimes close enough is good enough, and sometimes close enough isn't good enough, depending on how important this pivot is, the kind of volume that was there. Is it a double, triple top, etc.? Point I'm simply making here is this was not the easiest 3-bar play in the world, but there's certainly enough reasons that you might take it. 84% rule probably failed. And then what happens? You get a double bottom retest, and then it bounces back up, and then you have a consolidation, it probably grinds higher. I put this chart in here specifically, and you can see this is a relatively new chart. Okay, it's only, what, a week old? We've been seeing more of this recently. What is this that I'm talking of? Sloppiness. The markets have been a little bit more volatile, okay? So you might want to hold off a little bit and make sure you've cleared all resistance in environments like that. In environments where the market just shoots the moon and doesn't look back, you probably could take this a lot easier. But in markets that are choppier, you might have to wait for that pullback, or you might have to get a second entry or not get in at 935. Now, again, this is a 15-minute chart, but you guys understand what I'm getting at. Okay, so just be mindful when you have a sloppy pullback, the move back up is probably going to be sloppy as well. All right, here's an example, guys, of a relatively clean breakout. But notice, and this is really important, I put it on here for a reason. Okay, it's a few weeks old. What's going on here? Stock looks really strong off the open, right? But what happens? It sells off. This is where many of you will make a mistake. Okay? This stock bounces off the floor, 1 bar, 2 bars, 3 bars, 4 bars, 5 bars. Some of you guys, if this went higher on the next bar, would have bought this right at 106.50. Why? Ooh, it's a breakout. It's breaking out. Well, by definition, you're kind of right. It's breaking out over the high of the day. It had a previous consolidation in the first 10, 15 minutes of the day, and it's breaking above that. But we cannot take that because it's 5 bars up into this area, and whether it pulls back before it breaks out or pulls back slightly after, it's going to pull back. And I don't want to be part of the pullback. I want to be part of the move higher, the breakout, right? So this is an area where I think a lot of people confuse, and this is important for you newer folks. You confuse the favorites list and the prices that are put into the favorites list with actual entries. We see it every day in the chat room. I'll put in, for example, I don't know, BNTX over 120. Well, the stock might be trading at 116, 115, 117 all morning long. And then like 4 bars come out and it's trading above 120. People are like, BNTX over 120. Let's buy BNTX over 120. Well, I'm not going to buy it if it just moved from 116 to 120 without any resting period. That's crazy talk. Let it break 120 and buy the first pullback. Don't just buy it at 120 because in the pre-market we had an opinion about it, but that opinion has changed now because the stock pulled back to 115. Try to visualize that. Well, the same thing is happening on Peloton in this case. We're looking at this over 106.25, 106.50, and honestly, earlier in the day, it's looking really, really, really good. It's looking really good. And then it sells off to the tune of $2. Well, if it goes straight back up to 106.25, I can't buy it. And that's exactly what this thing did. And where's that volume spike? Right near the top. That's more like an ending volume spike. So we finally got a correction through time. Little bit of price correction, but a time correction. Pulls back to 105.60, comes back up, pulls back, and finally we get in over here. Boom. Patience pays, guys. FOMO does not. Every once in a while, yes. Okay, you'll take a FOMO trade and it will work, but you're not doing yourself any favors in the long run. I went over this chart a while ago, maybe a year ago. Okay? Now, it's important to understand, and this goes back to Tesla today. Things change. Okay? Just because a stock is in an uptrend on a daily chart doesn't mean you can't short it sometimes. Just because a stock's in a downtrend on a daily chart doesn't mean you can't go long sometimes. Okay? It all depends on expectation and the time frame in which you're working, right? Guys, this is right out of the textbook. Period. End of discussion. I wrote it so I know. What do we have within macro trends, guys? We have macro stages, right? 1, 2, 3, 4. What do we also have? Micro stages within the macro trend. Let me repeat that because this is the one area somebody who went off on a tangent today missed. There are macro trends and micro stages within the macro trend. And depending on your expectation and the time frame and chart you're using, you can trade those macro stages within the you can trade those micro stages within the macro trend. I just need that to be clear to everybody. Okay? And the person who was saying that earlier does the same thing. All right? Perhaps there's a little bit of ego that got to him today. I don't know. But we have macro stages and micro trends within those macro stages. Okay? So you can have a stock that's up, up, up. And guess what? It might pull back on the daily and you have a buy setup. But does that mean during that daily pullback, you can't short something on a 2-minute chart? I'll repeat that part. You might have a stock that's in an uptrend on the daily, and it's in the process of a 3-day pullback, of which it's likely going to pivot and continue its uptrend. So during that 3-day pullback, you're just absolutely unequivocally not allowed to short it on a 1-minute or 2-minute chart? No, that's not true at all. Okay? So depending on your expectation, you're allowed to do these things. So here's a stock that clearly gapped up. You can see it right here. Okay? Moves higher, pulls back, bounces, pulls back, bounces. And this is where we get into the double, triple bottoms. Now, guys, I don't know about you, but this is clearly a downtrend. Unequivocally. Lower high and a lower low. Lower high and a lower low. You need 2 or more lower highs and lower lows to be in a trend. Okay? 2 or more lower highs and lower lows, and you're technically in a trend. In this case, downtrend. Double bottom retest, bounces back up, triple bottom retest. This is a retest and failure to go lower. Guys, Tesla had a retest and failure to go lower today. Not once, but twice. On a 2-minute chart and on a 1-minute chart. It had a retest and failure twice. Bounced, pulled back. Bounces, pulls back. Okay? Now, the question here is this buyable? This is tough because you're not putting any higher highs in. So what this is suggesting to us is the move lower is finished and the stock is likely going to transition higher. The question then becomes, where can you get in? Over here is really aggressive. Over here is less aggressive because it put in technically a higher high and an equal low, and it's the third test. Okay? But we get a shallow bounce. That's tough. I mean, but you'd already be in the trade. So this goes back to what we talked about earlier. We have a really good understanding and idea that most likely this stock's going to go higher. Question then becomes, can we take advantage of it? And I would say in this case, yes and no. And you're going, what do you mean yes and no? What I mean is this would be an area to maybe take a small lot, a half lot. And then once you get a better area to add back to your position. Because if you're right, it should make it back up to this prior pivot high all the way up here. But you're not going to just buy it above this green bar because it broke this pivot. You don't just randomly buy stocks because they break a prior pivot. There has to be a pattern where you buy it. Okay? There has to be a pattern where you buy it. Okay? But this is just a great example of a stock that started the day bullish. It absolutely did. Got incredibly bearish and was technically in a micro downtrend and then got bullish again. Stocks do this all day long. Some stocks, we call them power trends. They gap up and they never look back. Some stocks gap up, pull back, put in a double bottom, and then move back into the uptrend. That's a micro stage 1, 2, 3, 4, right? In this case, we had a stage 2. We moved into a very short-term stage 3. Okay, double or lower high, lower low, stage 4, and then we put in the retest. Now we're in stage 1. Now we're back into stage 2. And this happened all, and I think this was a 5-minute chart. Okay, I took the time off it on purpose because it could be a daily, it could be a week, it doesn't matter. The concept is the same. Okay, so I hope that makes sense to you guys. And I'm telling you flat, this was done yesterday. This just happened to be a perfect scenario with what had happened today. Okay. So I want, basically what I'm getting at is understand, and this isn't just true for stocks, this is true for the market. Understand where the market is. Are you in a breakout scenario? Are you in an uptrend scenario? Are you in a trendline break scenario where the stock is extended, it's retesting, it's likely going to change directions? Knowing where you're at on the chart, trust me, it's 80% of the battle. After that, management takes over. Because if you get in at the right area, you're not likely going to fail on that trade. Okay, you may occasionally. I mean, stocks don't always do what we want them to do. But knowing that this is a double, triple, quadruple bottom and that it's probably not going to go lower is really, really important. Okay? Knowing that, hey, let me go back a slide. Knowing you can't just buy that breakout because it's breaking the high of the day is really, really important. All right? How frequently, and this isn't a pat on the back, I'm rhetorically asking, how often does somebody in the chat room ask me about a stock and I say, yeah, it's probably going to bounce up to this area and then it's going to fail and roll over? Typically, it happens on buy and sell setups. We get that question every other day in the chat room. Hey, Jared, what do you think about this entry right here? And I say it's probably going to bounce about 50% and then it's going to fail because of where it's happening and how it got there. Okay? So it's really, really, really important. And it goes back to this repeat slide. Most stocks move with the market. Most traders lose because they're on the wrong side of the market. And this isn't just the market. People confuse this with the Qs and the SPY and the IWM. It's stocks as well. Stocks make up the market, right? Know where you're at on the chart. Know what your expectation is as well. Because if you know the expectation and where you're at on the chart, you're not likely going to lose very often. And if you can sprinkle in a little relative strength and a little relative weakness, you're golden. But it takes patience and discipline to do those things. Because what happens, guys, and we'll kind of end with these comments, what happens is we look at a gap list in the morning and we get excited about certain stocks. Right? We do. We look, oh, that's a really nice gap. It's level 1, it's level 2. We get excited. Wow, look at that pre-market chart. Look at the volume spike. Man, there's a lot of institutional commitment. And sometimes we over-marry our bias. It's okay to have a bias, and it's okay to marry it to a point. But don't over-marry it. Okay? It's like, look, you love your spouse, but you have video evidence they're cheating on you. It's time to step back. Maybe I need to change my bias. My buy is now a sell. And we don't do that. Or I should say traders don't do that enough. They're so dedicated because they had a bias, their ego comes in and they don't want to be wrong. So we always talk about fear and greed, but the need to be right, we saw it today with an individual in the chat room. The need to be right supersedes everything with humans because we all have egos, some bigger than others. We have to resist that urge, okay? We do. We have to resist the urge. Step back and go, okay, let me reevaluate this. I know I had a short market bias today, but the market is telling me something different. Am I going to marry that bias and die with the lie? Or am I going to reevaluate it and with the new information, make a more accurate decision? Okay? These are things that traders, I think they struggle with. Because again, it preys on our need to be right. And I think it's something that we all have to work on. Some people have it really bad, some people don't. And that FOMO is strong. Okay? So I hope you guys learned a little bit about those market events. It took a little longer than I thought to get through that. And hopefully because of that, you'll be more equipped to take better trades and be on the right side of the market. And like I said, it's important. Always try to have a little relative strength and relative weakness to your trades because it gives you a little more flexibility. You don't have to be so perfect with your market call and your stock call if you have relative strength and relative weakness. All right, so again, I hope you guys enjoyed that lecture. I'm Jared Wesley. We'll get back at it again next week.